NEMA. Rather than gauging the stationarity or lack thereof of the market as a whole, in Austrian Investing 2, I zoom in on the individual firms and their exceedingly heterogeneous capital, moving from the macro to the micro, which is only fitting for an investment philosophy bearing the name Austrian. In so doing, we deploy all the tools we have amassed thus far to scout out and capture those rare roundabout investments that will make us truly Austrian investors. As always, we are guided by the Austrians' principles of parsimony and fidelity to reality. That is, they say only what they can say in simple tautological language, as opposed to the convoluted mathematical models of the mainstream, with the fewest inputs, if you will, which leaves them extremely constrained. By restricting themselves to qualitative but necessarily true statements, the Austrians often come under fire, even today, as being quaint or medieval. Yet they avoid the false precision that plagues the smartest guys in the room, who built impressive and clever computer models of the financial markets that seemed to predict just fine, until they didn't. Needless to say, this hyper-precise modeling approach, which characterized long-term capital management and other strategies cooked up by the mathematical experts, is diametrically opposed to our uniquely Austrian methodology. Just as I stated in Chapter 9, only the thinking behind Austrian investing can validate it. An investment strategy that seemed to work on the historical data can famously disappear, assuming it was not a spurious mirage in the first place, as soon as analysts become aware of it. This is one of the central findings in the efficient markets literature. But in this audiobook, I have used deductive Austrian reasoning to explain systematic forces of disequilibrium, and our logic also explains why other presumably non-Austrian investors, having a distinct humanness about them, will leave the proverbial money on the table. Our look at the data indicates not the truth of the underlying theory, but rather it shows us the magnitude of the potential gains. The historical data show us the importance of our theoretical deductions. Roundabout investing, a very apt synonym for Austrian investing, is all about the temporal structure of productive capital. As we recall from the slow-growing at first conifers and Henry Ford's capital structure extending from raw materials to automobiles, production by its very nature takes time. Roundabout production, therefore, cannot focus myopically on the immediate profit. Rather, it invests teleologically, building the indirect means, the positional advantage, toward the ends of profits that will not materialize in the near term. In fact, as we will see, it is all the better for us that such evidence is hidden from the rest of the investing public who focus on the seen and impatiently gobble today's marshmallows. Their impatience makes them blind to future potential, tomorrow's profits that are yet unseen but can, if we know where and how to look, be foreseen. Indeed, Austrian Investing 2, like Austrian Investing 1, is all about the straightforward plan of attack comprised in this audiobook, being patient now in order to be strategically impatient later. Siegfried, the Dragon Slayer. The telltale sign of what we are seeking is highly productive capital. From a Bombaverkian perspective, we know that the most productive capital is also the most roundabout capital. In a physical sense, the result is obvious. Bombaverk taught us that we can always find technological ways of producing more output with our inputs, if only we are willing to wait longer. Yet I want to go further and claim what is not so obvious, perhaps even to Austrian listeners. The most profitable capital structures will tend to be very roundabout as well. I am focusing here on the Austrian model of capital and production, that we have understood in teleomechanisms from the conifer to the caterpillar and the strategy of Robinson Crusoe, acquiring later stage advantages of efficiency through present stage disadvantages, roundaboutness. In this audiobook, I have developed a code word for highly productive roundabout capital, a name that embodies the best of the Bombaverkian approach, Siegfried. As we recall from our parable of Nibelungenland in Chapter 7, there is something special about Siegfried, joyous in victory, slayer of dragons, entrepreneurial hero, which allows him to provide the best products to consumers with great efficiency, as his trees and pastures and goat herd flourish, thanks to his exquisite Wunderhorn playing. Like Henry Ford, with time Siegfried amasses a roundabout capital structure to make products that people want to buy, when they want to buy them. Therefore, we know that the mark of a true Siegfried is a high return on investment capital, ROIC, best calculated by dividing a company's EBIT, operating earnings before interest and tax expenses are deducted, by its invested capital, the operating capital required to generate that EBIT. Wisely, Siegfried continually reinvests his profits into his business, becoming increasingly more roundabout, instead of pocketing the profits by paying out high dividends to himself or just accumulating cash. He is driven to act by what he sees as false prices on his factors of production, his capital and other costs are just too low relative to the prices at which he can subsequently sell his finished products. To put it simply, his enterprise can transform dollars spent on inputs into dollars earned from customers at a much higher rate than he could earn by lending the money out. A true entrepreneur, Siegfried finds those false prices to be, in Mises's words, intolerable. When he sees them, he has to act, which ineluctably makes him become increasingly roundabout, as he is continually building new roundabout capital from square one, and therefore even more efficient in the future. While driven by his ends, profitability, he takes aim on his means, the tools of higher-order capital goods. Most important of all, what truly makes Siegfried a Siegfried is that he is not all that sensitive to interest rates. His profitability is not terribly contingent upon marginal movements in everyone's time preferences or the central bank's imposition of artificial interest rates. Of course, Siegfried is not perfect. When there is a big credit collapse and a liquidation of assets following a period of monetary distortion, Siegfried will see a decline in his ROIC. Even he lost a little in 2008. But his capital likely remains profitable and productive, well above his cost of capital, even if the central bank should suddenly and sharply raise interest rates in the thick of a boom. After such a surprise move by the central bank to take away the punch bowl, the Gunthers of the world will be crushed, as their bloated enterprises were utterly dependent on the artificially cheap credit of the boom. They will be forced to scale back operations or fold altogether. In contrast, Siegfried will be okay, as his business model remains fundamentally sound. In the mass liquidation of the Gunthers, the crashing prices of various business inputs may cause Siegfried to regret some of his purchases made at the height of the boom, but that will be a luxurious position compared to many of his peers. Siegfried is akin to the conifer, as he willingly turns his back on the fray of fast growth that often exists only because of the artificial fertilizer of distortion, and thus is overlooked by those who have no way to appreciate what he is constructing. They are mesmerized by the fast, but likely unsustainable growth of the angiosperm hairs. With an intertemporal perspective, Siegfried cedes what looks like the prime places stampeded with competitors who race for the win, and instead he happily retreats, Wunderhorn in hand, to the rocky places, where the growing is hard at first, as he forgoes his profits today to build his tools of later efficiencies. Yet to perseverance and tenacity and an intertemporal view come the payoffs, rewarding those who are not obsessed with today and instead have a depth of field perspective. Yes, Siegfried will grow more slowly now, so slowly that he may not appear to be growing his profits at all, as he amasses his roundabout capital structure. But when the time is ripe, he will emerge with the greatest advantages, and when the field of competition is cleared by the wildfire that destroys unhealthy, malinvested growth, he is still standing, even ready to advantageously invest more. His slow but deliberate roundabout growth has given him the structure he needs to accelerate later on, to kick into high gear and outperform the rest, the tortoise that morphs into a hare, and then surpasses the mere hare. To move from our fable to an operational strategy for the real non-Wagnerian world, note that Siegfried qualifies as our investment ideal because of the first of two criterion: high ROIC, which prompts him to keep reinvesting profits into his capital structure to become even more efficient and eventually grow. This pattern explains why we should expect a strong correlation between above-average returns and a roundabout capital structure, even though such a connection is not usually made even among Austrian writers, and this expectation is confirmed by data. High ROIC firms show consistently and significantly greater increases in their invested capital compared to non-high ROIC firms. Academic Austrians tend to view above-average returns, what they would call pure profit as opposed to mere interest earnings, as due to superior entrepreneurial vision, while capital roundaboutness is handled in a separate equilibrium analysis of interest rates. Yet I claim that in the actual market, we should expect these two Austrian concepts to overlap substantially. Consider, the entrepreneur who foresees a profit opportunity in the distant future and who patiently reinvests earnings into his business year after year in anticipation has a much greater opportunity for, eventually, posting an enormous ROIC than entrepreneurs who are engaged in short-term projects. The fewer the rings spanned on Bombawerk's Jahresringe, the more commoditized the business. Thus, while there may be no direct cause and effect relationship between capital roundaboutness and above-average returns, once we think through the actual forces governing them, we come to expect an observed ex-post correlation between the two. As Austrian investors, by which I mean capitalistic investors seeking to accumulate productive capital, as opposed to the more common mere gambler investors seeking to exploit changes in prices on title to capital, we have two basic choices of roundabout paths. One path is to go the Siegfried route ourselves, as that other ideal Austrian entrepreneur Henry Ford did when he doggedly amassed factors of production to build his own self-contained, ever deeper and more productive capital structure. We too could mimic Siegfried and bring together our own factors of production in such a way that allows us to be similarly roundabout in our production as we discover and exploit what to us are false prices. The high ROIC of our Siegfried means that relative to his competitors, he is very good at taking investment dollars and transforming them into earnings. The ratio is much better than the going price of capital. This, of course, requires something special, a great insight, and an unwavering belief in what is perhaps merely a promising hunch, the Verstehen of Chapter 7. One might think of this as the burden of the angel investor. While important and sometimes even lucrative, this is beyond the scope of this audiobook. Yet as Austrian investors, there is another option open to us, to identify a metaphorical Siegfried and own a piece of him. That is, we can use our funds to buy title to some of his existing operation. We can thus exploit what are false prices only to Siegfried by acquiring and then stepping into his shoes. Yet this route has an additional variable, which makes us take pause. Unfortunately, we should presume that it will cost us dearly to get in. The baseline assumption of efficient capital markets would be that other investors are just as keen as we are, and that the price of stock in a Siegfried would already reflect the tremendous economic advantage indicated by his high ROIC, which is, of course, public knowledge. Yet for whatever reasons, and I will give my own thoughts and evidence shortly, this is not always the case. In other words, in the real financial markets, we often encounter high ROIC Siegfried firms where these superior efficiencies at turning invested and reinvested capital into future earnings are apparently not priced in. Back in Chapter 5, in our discussion of forestry development, I explained a concept that we can now fully deploy. In addition to casting our net for firms with a high ROIC, we are also looking for firms with a low Faustman ratio, meaning a low market capitalization of common equity over net worth, or invested capital plus cash minus debt and preferred equity ratio. In Chapter 5, I explained that this Faustman ratio is driven by the degree to which the ROIC exceeds the cost of that capital. So clearly one might expect high Faustman ratios, where the whole is greater than the sum of its parts, or the sum of the factors of production, to accompany high ROICs. When we make this more realistic and allow for the reinvestment of profits into more land, and thus eventual growth in those profits, this robust relationship remains. Stating it in Nibelungen terms, we want to acquire ever more roundabout Siegfrieds while they are priced like break-even Johanns, or even struggling Gunthers. The ultimate end for the Austrian investor is the same as for any other investor, profit. Yet the means are entirely different. Here, they are the central focus. The Austrian investor doesn't lunge in Lee fashion immediately for the goal. He doesn't set out directly to find firms with immediately rising profitability, or firms to hold while others also pile in immediately, or firms with immediate dividend yields, or even underpriced firms per se. Rather, his first task is to find highly roundabout, productive firms, ones with high ROIC that possess the circuitous means of economic profit. Then to these Siegfrieds, he applies a second filter or screen and looks for firms with a low Faustman ratio. This two-pronged approach would strike most investors as quixotic, simplistic, and even contradictory. By this point in the audiobook, though, the listener should understand that such a commonplace attitude is precisely what will deliver remarkable rewards to the roundabout Austrian investor. This strategy is neither easy nor automatic. We certainly won't find these companies on a Siegfried stock watch list, and they likely won't be making headlines. Some tricky analyses of financial statements are necessary, and we will have to resist once again that very humanness about us. Strangely, Siegfrieds are often the quiet, hidden, and even scorned treasures in the world of investment, because they often appear to be doing nothing much of anything at all, not progressing, even regressing, except for one very important thing. We can be confident that the incentives are there for them to diligently and roundaboutly reinvest capital. Thus, our goal is to identify precisely those firms that, in light of Austrian economics, we expect to eventually progress or grow their EBIT and thus deliver, perhaps after a large lag, a substantial return on investment in ownership of the firms. To drive home the rationale behind this Austrian approach, it might help if I note that neither of these screens in isolation is enough to warrant our attention. For example, a firm with a high ROIC but a correspondingly high Faustman ratio will be expected to experience its roundabout earnings growth. That is true. It might make sense as investors to take our funds and buy the same factors of production at the same false prices in order to copycat such a firm. but its high Faustman ratio means we don't want to invest in that firm by buying shares of its stock. On the other hand, suppose we encounter a firm with a relatively low Faustman ratio that also has a low ROIC. Armed with Austrian insights, we pass on such a firm. Yes, the low Faustman ratio might lead us to believe that the financial markets are, for some reason, underpricing the productivity embedded in the physical capital assets of the firm. Yet the firm's low ROIC makes us pause. If management perceives that the operation cannot earn a higher return on reinvested earnings than the going rate of interest, we can hardly expect them to plow the profits back into the business, and even if they did, it would be economically destructive malinvestment. Without more information, we should worry that this firm will provide no entrepreneurial profit, will thus not progress, and worse yet, will even regress. Now that I've spelled out why either criterion in isolation is inadequate, we can more fully appreciate why the two operating in tandem is just what the Austrian doctor ordered. A firm with a high ROIC will naturally engage in high rates of reinvestment in the business. The managers almost cannot help themselves, as this is a simple matter of putting available funds to work in an outlet with a proven track record, and over which they have exquisite control. Armed with our knowledge of Bombaverkian capital theory, we have a general presumption that such a firm eventually will be reappraised by the market as more efficient than its peers, as the accumulated roundaboutness eventually manifests in greater economic profit. How then does the second criterion, a simultaneously low Faustman ratio, come into play? Here we draw on Bombaverkian's subjective value theory. The simple fact is that many investors, including and even especially professional asset managers, suffer from extremely concentrated time preference, or what the literature calls hyperbolic discounting, discussed extensively in Chapter 6. Now, we have an explanation for why the asset markets may be undervaluing, dinging our productive little Siegfried, despite its bright future. The various equity analysts and investment managers may have concluded that this particular Siegfried will not see its earnings grow anytime soon enough. If the listener wants a real-world explanation for why this tends to be, even among highly productive firms, consider the fact that a sustained program of high capital expenditures would make a firm more roundabout, but would also depress future earnings for some time, as the income statements are saddled with higher depreciation expenses. Of course, in any specific case, the actual reason for an apparent undervaluation could be something quite legitimate, such as a pending lawsuit or regulatory ruling. Yet if we aim to find simple, axiomatic Austrian rules of thumb for identifying stocks likely to return superior returns, our two criteria, rooted in the Bombaverkian treatment of capital theory and subjective value theory, are remarkably robust. The high ROIC flags for us firms that are likely to experience earnings growth, while the relatively low Faustman ratio further segregates those firms where other investors apparently underappreciate this lucrative prize, lying as it does just beyond the horizon, and at the end of a roundabout route. It might be, of course, that for any particular firm, the insiders know something we don't, but in the aggregate, it might also be simply that most investors have a more immediate horizon, a much shallower depth of field than we do. Austrian Investing 2 is indeed the sibling to Austrian Investing 1. These Austrian Kinder are both essentially angling to accomplish the same roundabout task, to continually and cumulatively own highly productive capital. One might say that Austrian Investing 1 went about this longitudinally, by exploiting opportunities available intertemporally across time, and one might say that Austrian Investing 2 is now going about this cross-sectionally, by exploiting opportunities available at the same point in time, a handful of Siegfrieds found each month, for instance. Our pedagogical conifers, in their retreat to the rocky places, in order to ultimately outgrow their neighbors and intermittently take their land, similarly employ both cross-sectional and longitudinal strategies, respectively. This, too, is a highly intertemporal strategy. As was the case in Austrian Investing 1, here in Austrian Investing 2, we find that as we wait, in this case for EBIT to grow and the stock price to subsequently rise, we actively construct the very means of our subsequent superior profits. Produktionsumweg requires an intertemporal exchange of payment now for the tools of higher productivity later, to be soft now in order to be hard later, to retreat in this moment in order to advance all the more imperiously later on. And we know that the Bombaverkian opportunities of Austrian Investing 2, like the Misesian opportunities of Austrian Investing 1, are hidden from the eyes of less discerning investors. They see in these Siegfrieds only Johanns or Gunthers. Or, to switch our metaphor for a moment, the vast majority of investors encounter a hungry Robinson Crusoe, whom they see as catching fewer fish, which seems to make his operation unattractive, and they want no part of it. However, the savvy minority of investors, appreciating Austrian insights, can see beneath the surface and recognize when Crusoe is hungry not because of sloth or ineptitude, but because he is currently investing his resources into building a boat and a net. The Austrian investor sees the fish jumping offshore and realizes that Crusoe's inability to catch them is merely a temporary condition, as Crusoe is preparing himself for the big catch further downstream. Case Study: Buying the Siegfrieds. We are now ready to observe our scorned Siegfrieds in action in the real world. Our laboratory is the CompuStat database of reported financial data, as well as historical stock price and dividend data going back to the 1970s. Let's start by looking at the Siegfrieds and confirming that they do, in fact, tend to remain Siegfrieds. After all, if Siegfrieds were to quickly deteriorate into Johanns, then certainly our presumption of their ever-advantageous roundaboutness would be mistaken. On theoretical grounds, we expect a firm with high ROIC to remain in such standing, as its managers will continue to reinvest in the firm. Why wouldn't they? And this will only further solidify their positions of competitive advantage. The data match up with our theoretical deduction. It turns out that high ROICs have been sustainable. In Figure 10.1 of the downloadable PDF, we see that the Siegfrieds, the top line, defined here as firms realizing 75% or higher ROIC at the start of each 10-year period, have tended to persist as Siegfrieds, or have retained their elevated ROIC by the end of each 10-year period. To be clear, I acknowledge that there is nothing guaranteeing this result, and no doubt we can find individual firms with high ROICs one year that lapse into low ROICs in the future, or even go bankrupt. This is even assured by the preeminent regression fallacy, whereby an extreme value generated by random noise in a data series is consequently reversed when the noise abates, and assigning meaning to that reversal is a mistake. Mistaking the deliberately roundabout swerves described in this audiobook for randomness is a similar, though inverse, error. Yet in the real world, the type of far-sighted entrepreneurs who constantly reinvest earnings are the very people poised to seize profit opportunities that have eluded others, and they are ahead in the capital configuration race, so that in the aggregate, we expect a persistence in high ROIC. The statistical result is even more reasonable once we consider that certain intangible assets, such as the rewards of research and development, or brand name recognition, or the leadership skills of an owner, will very often show up in the measured return on tangible capital. We can see that being a Siegfried comes with tremendous advantage. In order to reap that advantage, and more specifically the advantages of Bombawerk's insights, my aim here is to turn these insights into portfolios, as it were. Now I will construct portfolios of Siegfrieds, choosing the best handful every month, using a highly robust screen, meaning wild numbers don't have an undue effect, as I equal weight each purchase. Each month I purchase the lowest Faustman ratio firms among those with recent ROICs above 100%, with further screening for size and liquidity, and I turn them over as they eventually fail to meet our criteria, checking each year. I ignore fishy financial values as well as sectors like banks. I start the test in 1978, solely due to requirements for sufficient available data. I use a spliced combination of CompuStat's point-in-time database, available starting in 1987, and its non-point-in-time database. As is apparent, these results don't materially change if I restrict myself just to the more timely point-in-time data. Figure 10.2 in the downloadable PDF shows this simple portfolio's results, specifically the cumulative equity in the strategy, starting at $1 in 1978, through time compared to the S&P Composite Index. Needless to say, these are tremendous results, like Austrian Investing 1 beating most, if not in this case all peers, in the simplest of non-optimized screens, another basic toy strategy, built only on economic logic and focusing on just ROIC and the Faustman ratio. However, again, these data say nothing of the validity of the Bombawerk arguments on roundaboutness. The data show us only the displayed magnitude of importance. Now, let's investigate what's going on under the hood here. Put simply, why are there highly productive firms, ROIC over 100% is an outrageously big number, so scorned that they have such low Faustman ratios to meet our thresholds? It turns out, as Figure 10.3 in the downloadable PDF shows, and as we anticipated, among the Siegfrieds, operationally defined in Figure 10.3 as companies with ROICs above 50%, in order to provide enough data for comparative significance, those with the lowest first quartile Faustman ratios, the dark line at the bottom, have seen their subsequent EBITs take a temporary turn for the worse, and the shaded 95% confidence region around the mean EBIT changes for the lowest Faustman ratio bucket indicates the rigor in this statement. In fact, the statistically significant differences between each progressive Faustman bucket would suggest that the market is actually pricing these differences in. As the EBIT paths diverge at 1 year, and as guidance and analyst forecasts seem to predict this far out in the future fairly well, this should not be surprising at all. What should be surprising, at first, is how fooled the market tends to be over the subsequent 1 to 2 year bend in the road. When you consider that these divergences are essentially, even entirely, with high statistical significance, accounted for by spurts of fixed and intangible capital spending, this is all the more surprising. These first quartile Siegfrieds are merely becoming more roundabout, sacrificing today for growth tomorrow, and paying the price today. As we know, roundabout production, bearing the costs of capital investment, typically results in an immediate hit on profits, particularly from non-capitalized investment, such as research and development. Our constant refrain sounds again. We live in the scene, what is available to us, and we extrapolate the scene such that we are deceived as it curves. Minor leaguers hit linearly extrapolated fastballs. Major leaguers hit curveballs. The roundabout is hard, and we are not biologically cut out for it. Thus, the stock market tends to be about immediate bets or expectations on distant outcomes, yet all that matters to the bettors tends to be the immediate outcomes. That is, among high ROIC firms, stock valuations and the resulting Faustman ratios seem to anticipate future profits in the short run so accurately that they miss the curves and the change-ups. It is a doctrine of investing that stocks follow their earnings, that, in the words of Peter Lynch, it's the earnings that waggle the wiggles in the stock market. So what's the sense of wasting time on sluggards? And naturally, the near-term earnings are all we see. As it turns out, stock market investors are less savvy than the hoary forestry investors of ages past, who overcame the dreaded axiom of the axe and saw the faster and more profitable tree growth just around the corner. The market focuses on immediate profits and growth thereof, immediate progress, all the while treating the productivity of the means of those profits as homogeneous. This is the penalty assessed by the myopic market as the price of Produktionsumweg. The premium goes to the marshmallow produced today, while punishment is meted out on Siegfrieds that devote their profits to becoming more efficient in marshmallow production tomorrow. No wonder Henry Ford tried to avert equity partners and considered typical Wall Street investment to be a sideshow. Contrary to my central tenet from Hazlitt's Economics in One Lesson from Chapter 1, the markets truly look at just the immediate rather than at the longer effects of capital and production processes. These are the two games always at play, with so little competition in the latter. Figure 10.3 in the downloadable PDF is reminiscent of Figure 2.1, depicting growth rates of conifers and angiosperms in Chapter 2. It is the quintessential Bombaverkian roundabout. Turn Figure 10.3 90 degrees counterclockwise, and we see my favorite image of literally going right in order to go left. That is, the first quartile Faustman ratio firms see lower EBIT for about the first 2 years, in contrast to the immediate growth of firms with higher Faustman ratios. And when one considers what's driving this detour to the right, it becomes clear that this is indeed going right in order to then better go left. Of course, all the other quartile firms have already engaged in the roundabout, and are thus already headed left, and of course the market fully appreciates them by then. In the tyranny of first consequences, in the market's systematic scorn for this circuitous path through the indirect means of economic growth, lies the very edge of Austrian investing too. The best investment approach may even be to search out such high ROIC companies where forward profits are expected to take this detour, a very difficult thing to do. The good news is we don't have to, as the market seems to be already systematically doing it for us. The next question to ask is, just how insulated are our Siegfrieds from the booms and busts of distortion demonstrated in the previous chapter? Since a Siegfried, by definition, is a far-sighted visionary, who can better anticipate future market conditions than his peers, and who has spent years building up a roundabout capital structure accordingly, and whose ROIC far exceeds his cost of capital, and his investment plans are thus generally insensitive to movements in rates? We should expect that he is more protected than the Johanns, and certainly the Gunthers, from engaging in malinvestment. Let's see what actually happened in the data. Siegfrieds aren't perfect. They are still exposed to the cluster of errors of distortion, just not as much as everyone else in the market. When the average stock does really well or poorly, as denoted in Figure 10.4 of the downloadable PDF by the S&P Composite gaining or losing more than 20% in a year, respectively, so too relatively, with over 95% confidence, does the Siegfried strategy, as seen in the conditional mean annual returns, the light bar, and 20th percentile drawdowns, the lowest dark bar in Figure 10.4 of the downloadable PDF. Thus, the Siegfried strategy benefits from low MS index regimes when the S&P composite has high subsequent returns, as per the previous chapter, and is somewhat hurt by high MS index regimes when the S&P composite similarly has low subsequent returns. Overlaying the same intertemporal strategy of the previous chapter, of facilitating opportunistic capital deployment following the routes of distortion, on the present strategy will confer even greater advantages. It truly pays to take a roundabout route toward roundabout capitalistic production. That is, our Austrian Kinder, Austrian Investing 1 and 2, get along well together. The former well hedges the latter, and the latter is the superior deployment of capital to which the former serves. In Austrian investing is a cohesive whole of intertemporal opportunism and the roundabout acquisition and construction of the factors of production. Indeed, from the strategic framework and logic accumulated through the entirety of this audiobook comes an effective framework for investors of all stripes and means. Value investing, Austrian investing's estranged heir. Austrian Investing 1 and 2 should both sound somewhat reminiscent of what has come to be known as value investing. Indeed, Austrian investing can be seen as value investing's intellectual forerunner, not only drawing on insights older than value investing, but, more significantly, providing clarity and focus to its underpinnings and ultimate systematic source of return. Although their paths cross at times, value investing does not strictly follow the Tao of capital. There are significant differences, largely in the thinking behind the strategies, most specifically Austrian investing's deliberately roundabout approach, rooted in a firm understanding of its edge. No mystery, as claimed by value investing's founder, in its pursuit of Siegfried opportunism. Thus, we can say that Benjamin Graham, considered the father of value investing and security analysis itself, and the horde of value investors who have followed his treatises are, in effect, an estranged brood of Austrians, an unwittingly splintered faction. Understanding the differences should help us refine, focus, and improve the broader approach of value investing, and perhaps coax some to the orthodoxy of the Austrians. Such adjustments to what is already an ingrained approach, as well as a better understanding of the real source of information and edge in the approach, as we will see, can be most productive. Benjamin Graham was born Benjamin Grossbaum. The family name means large tree in German, so apropos since he came so close to the archetypal conifer strategy in London in 1894. The surname was changed on account of the German prejudice surrounding the Great War. The family moved to New York when Graham was a year old and enjoyed a comfortable lifestyle until his father died in 1903 and his porcelain business began to fail. His mother turned the family home into a boarding house and then borrowed money to trade stocks on margin, which left the family in poverty after the crash of 1907. After attending Columbia University on scholarship, Graham became a clerk in a bond trading firm, then an analyst, a partner, and finally principal of his own firm. A Keynesian interventionist, particularly regarding the inadequacy of consumption during economic downturns, Graham extolled a commodity-based currency that was very similar to the so-called Ford-Edison money of Chapter 5, and, like Keynes, he was blindsided by the great market crash that came at the end of the Roaring Twenties. Ludwig von Mises, as we recall from Chapter 7, had little company in predicting the Great Depression. Graham, the Dean of Wall Street, lost nearly 70% of his largely arbitrage portfolio in 1929 through 1932. This would become a most formative experience for him, likely responsible for much of his value investing principles that would evolve. This was a purely inductive lesson, establishing value investing's legacy of remembering the Depression, though without ever recognizing the distortion that caused it. Graham's opening line of security analysis, from Horace, though it could be right out of the Lao Tzu, "Many shall be restored that now are fallen, and many shall fall that now are in honor," tells the paradoxical story of the monetary-fueled market swings we saw in Chapter 9, and in that is a pretty good, though overly simplistic, approximation of Austrian Investing 1. There is perhaps no better illustration of his central margin of safety principle in action than Figure 9.3 in the downloadable PDF. In Graham's metaphor of the bipolar Mr. Market is a sound, though proximate, approach to avoiding the ultimately Austrian-explained traps of distortion and entrepreneurial incompleteness of the imaginations. Had he heeded the Austrians, he no doubt would have diagnosed the real causes of Mr. Market's personality disorder. There is much common ground between value investing and its Austrian predecessor. Certainly value investing is as close as we come to it in practice today, having become a popular intuitive approach, though I would argue that a small percentage of the value practitioners truly share the original focus laid out by Graham in his authoritative texts, Security Analysis in 1934 and The Intelligent Investor in 1949. the same publication year as Mises's English language version of Human Action. One might say that Graham gave the practice of investing a rigor, logic, and entrepreneurial orientation not commonly seen before, and in that he was very Austrian. As Graham famously noted, investment is most intelligent when it is most businesslike. Perhaps Graham's greatest insight was to stay out of the shadows of securities markets, ignore the sideshows, and instead focus entirely on the entrepreneurial action itself, the business, the capital. A diligent researcher of stocks, he had a laser focus on capital as the tangible asset and the thing that is ultimately owned in a stock. We can see this in the MS index and the Faustman ratio, as well as Graham's price-to-book ratio, or P over B, which simply compares a firm's equity to its total net depreciated book assets. All three ask, what is the whole relative to the sum of its parts? It is not clear whether Graham ever read Faustman or the Austrians directly. Though he was fluent in German, he admitted to being unschooled in economics. In his P over B approach alone, Graham had good results. After adding a litany of quantitative screens, from debt restrictions to long-term earnings and dividend growth, and stability to price-to-earnings, P over E ratios, spelled out in his book, The Intelligent Investor. Over his long career as an investor, he did quite well. His multi-ingredient, quantitative stock portfolio recipe is the stuff of modern-day financial engineers. We might say, however, that traditional value investing has been something of a misnomer. Traditional value stocks, defined by low P over B and P over E ratios, have been shown to have statistically similar revenue growth as traditional growth stocks, and have had lower ROIC than growth stocks. This is yet another instance of naively treating all capital as the same, as a homogeneous blob. Consider that P over B and P over E ratios are utterly incommensurable unless we assume all firms have the same basic capital structure. In reality, firms have different degrees of roundaboutness, and hence variability in their ROIC. Indeed, investors must always delve deeper into the means of economic profit, certainly a central message of this audiobook. Between Austrian investing and value investing is again the difference between depth of field and the telescopic long term. The latter is about waiting patiently over a long interval, as if for a far-off coupon at the very end, the plodding tortoise, or Marco sitting with his rod. The former is about patience now in gathering the factors of greater potential coupons to come, the accelerating tortoise, hare, or Crusoe. Both require discipline and patience, but Austrian investing is concerned with the intertemporal process at work, rather than just the endpoint. Interestingly, the man who is most closely associated with value investing today, Graham's one-time pupil and perhaps one of the most successful investors in history, Warren Buffett himself, once had a close brush with the Austrian school via his father, Howard Buffett. In a letter from 1962, Howard wrote to Austrian economist Murray Rothbard, seeking a copy of his book, The Panic of 1819, for his son Warren, who is a particularly avid reader of books about panics and similar phenomenon. It is apparent that, despite the son's later vocal criticisms of much of what could be considered Austrian orthodoxy, his basic investing actions are more closely aligned with it than he would ever admit. Most have forgotten how unpopular and even ridiculed Warren's yielding Zohua and very Misesian cash position was in the late 1990s. Over the years, value has sprouted many variations on the Austrian Grahamian theme. In 1992, Eugene Fama and Kenneth French formalized a value factor, which was basically Graham's P over B measure. Another approach, called the Magic Formula by Joel Greenblatt, combines our traditional ROIC screen with a simple EBIT relative to enterprise value screen. And there is a similar screen known as quality, whereby high gross profits to assets, which avoids penalizing high capital investment, and low P over B ratios are selected. These cover the variation gamut, though there are certain countless sub-variations on these, including their intersection, such as perhaps the approach of Buffett, and in fact triangulate or cross-verify the Austrian Investing 2 approach. All introduce noise by assuming additional degrees of freedom, too many to name, in this case of Graham's intricate screens, heterogeneous capital productivity, in this case of Fama French's sole P over B parameter, heterogeneous EBIT growth rates, in the case of Greenblatt's growth-sensitive P over E parameters, and heterogeneous capital depreciation and thus productivity, in the case of Quality's depreciation-free gross profit parameter. But as much as they might approximate this approach, they fail to necessarily isolate what matters, roundabout capital and its price. So we should expect these variations to capture some of the Siegfried portfolios, some of their edge, but with some added noise, evident in lower returns resulting from lower information content in the screening methods used, as well as inconsistencies across a range of portfolio construction methods employed. To see if this expectation holds, I tested the performance of these portfolios. In my experiment, I own 40 stock positions for 1 year, and I stagger how many I buy in each monthly mini-portfolio in different ways, as well as limiting how large each mini-portfolio as well as each position may swell before constraining it. Such variation and somewhat arbitrary portfolio construction techniques result in essentially different portfolio constituents, and thus nicely reveal a degree of luck and inconsistency in some of these results, as well as remove much of any ability to optimize, thus keeping the author honest. All portfolios share the same screens, ranging from tradability, size constraints, and general noise constraints. I start the tests in 1978, as before, which once again doesn't impact the relative results. Figure 10.5 of the downloadable PDF shows the range of performances found, as well as the mean performance across this range. Here we see a literal stair-step up from the naive capitalization-weighted S&P composite up to our most pure and archetypal Austrian approach, the Siegfried's portfolio. It is not an evolution, as the top step came first in the historical development of these approaches, and the others sporadically branched from each other, but it is nonetheless a refinement of both the methodology and, most importantly, of the thinking behind them. The point is that we have a methodology that separates the wheat from the chaff, focusing on what matters and ignoring what doesn't. In this, and to its credit, the value approach has come very close. But focusing the mind does so much more than just adding an additional 5 to 10 percentage points to what some smart investors are already doing pretty well. Most importantly, it provides a logical and sound basis for understanding the why. The rigor and appeal of Austrian investing is in the intuitive logic of its principles. Even before we test, we know why our edge exists. For most value investors, even when they see the edge that their approach provides, they do not comprehend it, typically relying on mere nebulous long-term price mean reversions, and Graham famously called it one of the mysteries of our business, and it is a mystery to me as well as everybody else. They thus remain susceptible to being swept away by the next seemingly attractive investment scheme and distorted environment to come along, as even Graham himself was in the late 1920s. Truly, the why is all that matters when we are faced with our profound intertemporal constraints amid investment results that appear, to the Phineas Gages among us, unacceptably inconsistent, even recklessly irresponsible. Understanding that we are investing in a means to subsequently greater profitability, not greater profits themselves, we see that we must take the detour in order to gain the intertemporal edge of greater tools. Such thinking clears our field of view, giving it that all-important depth. When considered as a somewhat noisy and tweaked version of Austrian investing, perhaps value investing's mystery can be put to rest. Production that leads to entrepreneurial profit is an exceedingly roundabout process, which takes time and capital, and thus patience in acquiring the indirect means of that process. We should not expect such entrepreneurial profit to be easy or even desirable as it starts the process, and made even less desirable by monetary distortion. To those who understand and can thus suffer through the process go the spoils of capitalism. A Zweck finally attained. In Austrian Investing 1 and 2, we have finally reached the destination, the Zweck of the Tao of capital. When brought together, Austrian Investing 1 and 2 are nested roundabout strategies, the first used to deploy the second, the grand sure strategy of the Taoist sages. Each is a mittel to a higher Zweck, culminating in maximally productive capital investment and reinvestment, a progressing economy and civilization. The strategies are quintessentially Austrian, with Austrian Investing 1 relying on concepts developed by Mises, and Austrian Investing 2 relying on concepts developed by Baumbawerk. However, as stated in Chapter 9, Austrian Investing 1 is very difficult for most investors. The only applicable takeaway will be to avoid the stock market when distortion elevates the MS index. Fortunately, the Tao of capital does not require that investors simultaneously employ Austrian Investing 1 and 2. Both Austrian Investing 1 and 2 can be pursued even as standalone strategies, as each on its own beats the vast majority of professional results, to exploit distortion, which also includes the basic Misesian strategy of Chapter 9, and to identify and invest in mispriced productive capital. As a devotee of the Austrian school all my adult life, and having had the pleasure of delving more deeply into the texts during the writing of this book, I can say without question that the influence of the men from Vienna has been profoundly meaningful. The source of any success that I have achieved as part of the market process. It has been my intention in this narration to share this knowledge, and in the last 2 chapters in particular, to provide a practical application and takeaway of what we have learned. No matter what action you take as an investor, once again, What is far more important to consider is the thinking behind this methodology. Are you sure in your approach, taking the roundabout and teleological means end path, or are you Lee, focusing only on the immediate end, the returns of today? It is not for everyone. If it were, the advantages would be lost, but it remains an important ideal for every investor, no matter how they perceive the ticking of the clock. All can stand in the company of Bastiat and Menger, Bambaverk and Mises, and Lao Tzu, Sun Tzu, Clausewitz, and of course Klipp, to gauge their approach. The relevant question to always ask, then, is, how far are you from the Austrian ideal? Let this one query serve as your compass and your map as you continue on your own path along the Tao of capital. Epilogue. The Sisu of the Boreal Forest. The conifer, as the leitmotif of this audiobook, conjures up the essential lesson of the roundabout, going right with its slow yet steady development at first until finally reaching a stage of maturity at which it can go left with accelerating growth that outpaces its competition. The slow then fast pace allows the conifer to build and configure its structures, amassing the necessary capital, such as thick bark, a high canopy, and more efficient foliage. This pattern of development requires tenacity and persistence, the necessary ingredients of the roundabout. The intertemporal world of the boreal forest and its strategies of survival stretch back epochs through twists and turns, growth and decline, and internal battles for survival among competing plant species and voracious herbivorous dinosaurs. In contrast, humans, who made their appearance on the planet much later, remain overwhelmingly anchored in the realm of the present, made all the worse by our inherent wiring around time preference, so that we value, indeed overvalue, today's marshmallows more than the prospect and potential of many more to come. Our societal attention deficit disorder steals our focus away from the protracted path toward our shallow depth of field. Thus, we become prone to making short-sighted, even disastrous mistakes with decisions that undermine the ability of our forward selves, our look-ahead trees, to act opportunistically. Like the conifer, we need perseverance to equip ourselves to triumph over and from falling behind, while never being fazed by it, even to the point of loving to lose and hating to win, Klipp's paradox, which started us off along the Tao of capital. Because of the sheer grit it engenders, and the prominence of indirect and sometimes costly means it allows. To be roundabout is to expect adversity, as opposed to just the false binary choices of failure and success. It is a prerequisite of the circuitous nature of progress itself, such as we found at the Weiqi board, where the sure strategist pursues positional advantage for later potential, which until the end of the game appears to be a losing strategy. All the while, the Lee opponent goes for the more comfortable direct assault in hopes of a quick and decisive victory. The great artists and entrepreneurs and economists have well understood that anything worth doing takes time, and so have their polar opposites, the military strategists, thus giving us the spectrum of the very creators and destroyers of civilization. Each in his own way has followed the common thread of intertemporal exchange, as explained in Chapter 3, the patient pursuit of an intermediate state, the efficacy of which furthers the realization of a desired final state. And so, achievement of one's eventual Zweck only comes after much effort, moving from zeal to zeal, along with a good deal of waiting, even to the point of testing the limits of one's perseverance. Both encourager and sustainer, such tenacity maintains our resolve along the indirect route from intermediate means to eventual ends, a journey we know is nearly impossible, the circuitous road least traveled, because of that very humanness about us. To overcome our human nature takes stamina, the ability to stay focused on and committed to a goal or objective, like the roundabout conifer that moves beyond the reaches of its competitors and hunkers down among the rocks through survival adaptations, such as symbiosis with helpful fungi, all the while waiting for the opportune moment to make its move into the fertile areas after the wildfire. The epitome of sure, the conifer exemplifies the cunning of Sun Tzu's guerrilla warriors, battling across a temporal depth of field. We, too, must possess qualities that are best captured in a word that comes from deep within the boreal forest, where else of Finland. Sisu. The world learned Sisu from the victorious Finns. In the early months of World War II, not long after Ludwig von Mises's escape from the Nazis, deep within the north woods of the taiga, another battle was waged, the 100-day Winter War of 1939 through 1940, during which outgunned Finnish forces fended off the much larger Soviet army in what is perhaps the best example of sure in modern warfare. Neutral Finland was unluckily caught between the two equally evil and totalitarian clashing powers of Stalin and Hitler, and was thus an immensely valuable path between the two for whichever could seize it first. Although much is often made of the underdog story, we must recognize that the Finns' victory was not some inexplicable event. Rather, it was the result of a carefully executed strategy right out of the Sun Tzu and Vom Kriege. As we will see, the former is evident in the use of Schur, as nimble Finnish troops on skis avoided direct clashes and instead maneuvered into position within the snowy, forested terrain in order to gain the upper hand. Influence of the latter is found in the very conduct of the war, particularly by the Finns, who attacked key focal points along the advancing Soviet lines and thereby fractured a large opponent into much smaller pieces that could be surrounded, attacked, and defeated. The Red Army, too, had its share of Prussian-German influence, but Joseph Stalin had tried to purge it from the Soviet forces by imprisoning or executing many senior officers. Thus, the forces that invaded Finland were typically led by less experienced mid-level officers, who at times acted as if they were following fighting manuals written for a different time and place, such as assuming that troops would be able to ski without ever being trained for fighting and firing weapons in snow. The Soviets' unified military doctrine allowed for no flexibility in field command. They adhered to the strict dogma of decisive engagement without question or alteration. Among these many influences and factors that led to the Finnish victory, we cannot underestimate the importance of Sisu. Difficult to translate, a linguistic trait shared with Schur, Sisu has been compared to having guts, moxie, courage, toughness, tenacity, stubbornness, strength of will, and determination. Sisu is perhaps best thought of as a gritty perseverance, making it a natural complement to the strategic positional advantage of Schur. Inherent in Sisu is intertemporal endurance, not gritting one's teeth in a difficult moment, but rather possessing fortitude that sustains along an arduous path, from one seemingly insurmountable challenge to the next. Sisu permeates the identity of the Finnish people, capturing their national character long before they were an independent nation, with a gritty perseverance rooted in the land and history. Flat forested tundra, pitted with lakes and marshes, this isolated land is plunged into Arctic darkness for a significant portion of the year, making even daily life a test of endurance at times. Overlaying such will to survive is centuries of having been a battleground for the Swedes to the west and the Russians to the east. Finland was part of the Kingdom of Sweden until it was captured by the Russians in 1809 and made into the Grand Duchy of Finland, which was then slowly assimilated into Russia. During the Russian Civil War of 1917, Finland seized the opportunity to declare its independence and held off the Russian threat with forces under the command of General Carl Gustaf Mannerheim, a staunch anti-Bolshevist who had been in the court of Tsar Nicholas II. The Treaty of Tartu, signed in 1920, formally established peace between Finland and Russia, yet even then the lingering tensions foreshadowed another war to come. The strategic advantages against the threatening Nazis, such as the Gulf of Finland, and large nickel deposits discovered in the former Petsamo region, later ceded to the Soviets, baited the Russian bear. Stalin wanted Finland back. Russian propaganda in late 1939 provided the cover for aggressive, overt military action. Imperialists were said to be planning to use Finland to stage an invasion of the Soviet Union, even though Finland, at the time, had a population of about 3.7 million, and the USSR's was nearly 180 million. The first shots of the war on November 26, 1939, were supposedly fired from Finnish observation posts in Soviet territory. Yet historians believe the Mainila shots, named for a nearby village, could not have been fired by the Finns, because Mannerheim had ordered all guns withdrawn from these outposts to avoid such an incident from happening. Posturing that it had been provoked, the Soviets rolled into Finland in tanks, mimicking the German blitzkrieg, which had proven effective in the heart of Europe, where there were well-defined centers of supply and communication to be targeted. The Finnish forest, however, offered no such targets, only natural obstacles that thwarted such cumbersome military operations. The Soviets further burdened themselves with truckloads of propaganda material and brass bands to celebrate what was anticipated to be a swift and decisive victory, but without winter uniforms and supplies for a prolonged campaign. What better illustration of Lee can we imagine than a direct assault with plans for a celebration